Most traders think they need a better strategy, so they jump from candlestick patterns to supply and demand to smart money concepts to volume profile, always chasing the next setup that is finally going to fix everything. But here's the part nobody wants to hear. A lot of the time, your strategy isn't the problem. You're just taking the wrong trades. Right setup, wrong location. Right pattern, wrong conditions. Right idea, but you got in after the move already happened, and then you blame the strategy, when the real problem was trade selection. So in this video, I'm going to walk through the no trade rules that keep you out of bad trades before you ever click buy or sell. And stick around to the end, because I'll show you one thing almost no trader journals, and it might be part of what actually gives you an edge. Welcome back to Busy Futures Trading Lab. This channel is for traders trying to get better without turning trading into chaos, especially if you're doing this around a full-time job, family, responsibilities, and limited screen time. When your time is limited, you cannot afford random trades. You cannot sit there chasing candles all day, and you definitely cannot keep switching strategies every time you take a loss. So today, it's not about a perfect indicator. It is not about a secret entry. It is about something less exciting and far more useful, knowing when you should not be trading at all. Rule 1. A signal is not a setup. A losing trade does not automatically mean your strategy failed. Sometimes the strategy was fine. You just used it in the wrong conditions. A candlestick pattern in the middle of chop is not the same thing as that same pattern at a real decision area. A pullback in a clean trend is not the same as a pullback in a market going nowhere. A fair value gap, a demand zone, a moving average cross, or a candle signal is not automatically a trade. A signal is only one piece of evidence. A setup is the full picture. Location, structure, room for the trade to work, risk that makes sense, and a clear enough read that you can take the trade without forcing a story. The trap is treating one piece of evidence like permission. You see a wick and call it rejection. You see a pullback and call it your entry. But the better question is not, did I get a signal? The better question is this the right environment for the signal to mean anything? Because a setup without context is just a candle with a good story. And traders are very good at telling themselves stories. Rule number 2, fight the urge to trade the middle. And I say fight the urge on purpose, because that is exactly what it feels like. The middle is tempting, price is moving, candles are forming, you see green, you see red, and it feels like something is happening. But most of the time, the middle is just noise. Price has left one decision area, but it has not reached another one yet. You're not responding to a clean level. You're guessing. For a busy trader, this is where real damage happens. You waited all day. You finally sat down. The market is open. You want action. But the market does not care that you finally have time. This is why this is not just a chart rule, it is an emotional rule. The middle tests your patience. It makes doing nothing feel like weakness. But sometimes doing nothing is the discipline. So before you click, ask yourself, am I at a real decision area? Or am I just reacting because price is moving? Because movement does not equal opportunity. And if you are trading the middle, you are probably trading noise. And noise is expensive. Rule number 3, if you cannot read the structure, do not trade. If you cannot tell whether the market is trending, ranging, reversing, or chopping, why are you risking money in it? This sounds obvious, but this is exactly where traders fool themselves. They stare at the chart long enough to invent a story. Maybe this is a pullback. Maybe this is a reversal. Maybe that is liquidity getting swept. Maybe this is the start of a breakout. But if you have to force the explanation, the structure is not clear. And unclear structures should make you cautious, not confident. A clean trade should be explainable in plain language. Price is trending up. We pulled back into an area of interest, Buyers defended it. Now I'm waiting for confirmation. That is structure. Or price is ranging. We are near the top of the range. Sellers rejected the high. Now I'm waiting to see if price rotates lower. That is structure. But if your explanation sounds confused, emotional, or complicated, that is a warning sign. You do not have to catch every move. Your job is to trade only when conditions are clear enough to make a disciplined decision. So here's the rule. If you cannot explain the structure in one sentence, do not trade it. Rule number 4, don't trace the trade you missed. This is one of the fastest ways a good idea turns into a bad idea or a bad trade. The direction may be right, the setup may have been there, the move may have already been working. But if you miss the clean entry, that does not mean you should force yourself into a worse one. Look at what happens when traders chase. Price starts moving, they hesitate, then the move extends, now they feel behind. They do not want to watch the market move without them. So they jump in late and tell themselves they are being decisive. But that is not confidence. That is chasing. And chasing changes everything about the trade. The risk is worse, the stop is wider, the target is smaller, the emotional pressure is higher. Even if the original idea was good, the entry may now be bad. That is why you need a rule for missed trades, because a missed trade is not just a missed opportunity. It is an emotional trap. The mature trader says, I missed it, I'll wait for the next one. The dangerous trader says, I missed it, but maybe I can still get in it. That one sentence can wreck an account. Being right but late can still lose money. Rule 5 is especially important for busy traders. Do not force trades after your best window has passed. This does not mean the market can never move later in the day. It can. But your best window is not just when the market is open. Your best window is when your strategy, your energy, and the market conditions actually line up. For a lot of working traders, the best opportunities may show up during a specific part of the session. Maybe it is the first few hours. Maybe it is a certain window where volume, structure, and momentum are easier for you to read. But outside of that window, the market can start playing a different game. Volume changes, price action changes, your focus changes, and the problem is your schedule does not always line up with your edge. You finally get into the screen at lunch, the clean move already happened, now you feel like you need to make something happen. But that is not trading your plan. That is trading your guilt about missing the window. Knowing your best window and respecting it when it is gone might be one of the most useful things a part-time trader can do. If you missed it today, you did not miss your only shot. You get another window tomorrow. No trade rules come before entry rules. Notice what every one of these rules has in common. They all happen before the entry. Most traders have plenty of entry rules. They know what they want to see before they click. But they do not have enough no-trade rules. And without no-trade rules, almost everything starts to look tradable. The green candle looks tradable, the red candle looks tradable, the pullback looks tradable, the breakout looks tradable, the reversal looks tradable. And slowly, your strategy turns into a weapon against you. Not because the strategy is bad, but because you are using it with no boundaries. So before you ask, where do I enter? Ask the better question first. Am I even allowed to trade here? No trade rules are not there to make you scared. They are there to protect your best decisions. The goal is not to avoid risk forever. The goal is to avoid bad risk until the right conditions show up. Journal the trades you didn't take. Now here's the thing I told you to stick around for. Most traders only review the trades they took, but the trades you avoided are part of your edge too, and almost nobody writes them down. If you almost chased a breakout and stopped yourself, that counts. If you sat out the chop, that counts. If you almost traded the middle but waited, That counts. If you nearly took a revenge trade after a loss and closed the platform instead, that counts. That is discipline, and discipline needs evidence. So when you review your trading day, do not just ask, how much did I make? Ask, what bad trade did I avoid today? That one question changes your focus. It teaches you to value patience. It teaches you to respect restraint. And it reminds you that not losing money in bad conditions is its own kind of win. Sometimes the best improvement in your trading is not a trade you added. It is the bad trade you finally stopped taking. So if your strategy keeps failing, slow down before you throw it away. Was it really this strategy? Or was the location wrong? Was the structure unclear? Was the entry late? Were you trading the middle? Were you forcing a trade after your best window had already passed? Or were you just tired of waiting? Most traders do not need another strategy nearly as much as they think. They need better trade selection, they need stronger no-trade rules, and they need patience to wait for conditions that actually support the trade. So here's my question for you. What is the one trade you are always tempted to take, even though you know probably you should not? Drop it in the comments. I am building the next videos around the answers, and I'm also putting together a no trade rules PDF because most traders have entry rules, but not enough rules that keep them out of bad trades. It's coming soon because your edge is not trading more. It is knowing when to stay out. Trade less, execute better.